I'm Osborne Foreman, and in this video I'm going to show you how to build a dividend stock portfolio that gives you monthly dividend payments using the Trading 212 app, and more specifically the pies part of it. So if you find the video useful, as it has taken a very long time to make, one of the longest it's taken ever, please show me one of these to support the channel. That wasn't good, I'll try again. One of these to support the channel, thank you. Also, my face looks like I've been wearing some form of luchador mask. Sensitive skin, this happens often, I'm sorry if it bothers you. I should disclaim also that I'm in no way a financial advisor or financial professional, so please don't take what I say as financial advice. Furthermore, I'm just a young lad on the internet with a passion for stock market investing. And the information I'm going to use will relate to the UK stock market or stocks listed on the London Stock Exchange, but this doesn't mean that this information can't apply elsewhere. I'm also going to put a link in the description to this portfolio so that you can view it or copy it yourself if you use the Trading 212 app. The first step is to gauge your own personal risk tolerance, and this is basically how comfortable you are with losing money and how comfortable you are with the volatility of day-to-day swings. Some stocks have a daily volatility of more than 10%. Argo blockchain, for example, but some stocks rarely move. An example of this might be the London Stock Exchange Group, which rarely moves between 2% each day. Also, it's worth noting your investment horizon, which is how long you're prepared to invest for, or when you plan on retiring and living off of this dividend income. I personally am 21 years old. Naturally, I have a higher risk tolerance, and this means that I'm able to invest for the next 40, maybe 50 years, which is a very extreme situation, but I am prepared to invest for life. This means that I am very likely going to be able to outweigh any market crashes or recessions, meaning that since I have that time on my side, I'm unlikely to sell at a low. Ultimately, meaning in the off chance that we see a market crash dipping our stocks by 70%, that I will have a long enough time period to remain invested in the markets, buy more, and benefit from it. I should also note that this isn't just about how headstrong you are, but rather how well you can stomach risk and losses. This is mainly a nature or genetics thing, although I'm in no way a scientist, I couldn't explain it, but it basically means that some people are more risk tolerant than others, and that's fine. Ultimately, as long as you're aware of your own risk tolerance, you can make informed investing decisions and not stay up at night stressed over a potential loss of investment. Once you know how much you're willing to risk, it's then worth looking at the amount of holdings in your portfolio. A common practice is to hold between 15 to 25 stocks, and I personally would go as far to say as to not hold more than 25 stocks, as at that point you're not really benefiting from being a stock picker. One, it'd be very time consuming to track all of these companies, and two, you might as well just buy an ETF or index fund. But this does diversify you between systematic risk, which is something that is quite important. This means if you held 20 stocks in your portfolio, if one of these companies were to go bankrupt, you'd only lose 5% of your total investments. Whereas, for instance, myself, I hold 6 stocks, and if they were all equally weighted, that means I could lose 16.67% of my total wealth. Furthermore, the average expected market returns of the FTSE 100 is around 7.5%, so that's more than 2 years of returns should a company of mine go bankrupt. In reality, for me, it's a lot worse. I actually could lose up to 46 of my portfolio should Boohoo go bankrupt, although this is very, very unlikely as I select stocks with the highest quality of balance sheets, those in very resilient industries, and are very unlikely to go bankrupt. And that's why I have less stocks, plus a higher gauge for risk, seeing as I'm not as worried about it as much, as at the moment this money isn't that much. It's a lot to me, but in the future it could be worth a lot more. Holding around 20 stocks on its own does not save you the risk from the stock market, especially if you're invested in very few sectors or industries. So it's worth diversifying your stocks between different industries and sectors. This means that you're not caught up in one market. An example of this would have been the dot-com crash, which happened at the end of 2001, which famously all of these tech companies were very overvalued and had experienced a massive sell-off. A majority of these companies have not reached the peaks they had reached in 2001, and so you would have lost a lot of money back then even if you stayed invested. These applied to technology stocks and telecom stocks that people were buying over future expected revenue, which sounds quite similar to today's market, with the hype around Tesla, EVs, and also those high growth technology stocks that are making losses but doing that to grow faster than their competitors. So what I'm trying to say here is that you shouldn't put all your eggs in one basket, but rather spread your investments across different sectors and industries in which you understand to therefore make the most out of your diversification. However, try to avoid a personal mistake I made, and that's spreading your eggs and putting them too thinly between each basket. This is a thing called diversification, typically applied to holding far too many stocks in your portfolio, like I had mentioned earlier. But in this case, this means not trying to put an investment into every sector, as you may not understand them fully, and some sectors are just simply aren't that good. An example of this is something I personally don't understand despite trying my damn best. It's the energy sector. This is a sector I do not understand. I've tried making loads of videos on it, but it just doesn't make sense to me. This means I shouldn't invest in what I don't understand, and therefore it's unwise for me to invest in the energy sector unless I was looking for diversification into it using ETFs. So naturally, I avoid buying stocks encompassing this sector and put my investments elsewhere. That way I can understand the investments in the other sectors more, have more conviction of when to buy or sell the dip. A pure example of this could have been when I first started my portfolio in April 2020, I was buying a lot of Royal Dutch Shell. I realised that I really didn't understand this investment, took a 2 to 3% loss and sold it. And this was up till June, so when they had really peaked up quite high, and then you could see how they dipped for the rest of the year, and I've only just recovered. If I had held this investment over that time period, I would have gotten maybe a 4% return, so in total 8% from my losses and gains. Weird calculation, but you can kind of see. Whereas my portfolio returns at this point is something like 27%, so that would have massively dragged down my returns, especially considering at the time it was one of my second or third biggest holdings. It's also worth noting that despite starting my portfolio in April 2020, which is all on the channel, you can see my UK investing playlist, I'll leave a card at the top right of the video for you, I initially had plans for a dividend growth portfolio. And whilst I still invest in dividend growth stocks, it's certainly transitioned more to higher growth rate stocks with less neediness on dividends, simply because I won't need that income now and I'll transition slowly when I will need to draw down upon it. This means that if I was purely investing in dividend stocks and looking to be financially free and live off the dividend income, I likely would not hold 6 companies, but rather hold between 10 to 15 companies, as that gives me good diversification, but also means that I've got more frequency of dividend payments, whilst also still having enough equity in these stocks to have a more substantial dividend payment each time. And the idea is that I would eventually have this wealth to then preserve it upon retirement, rather than risking it for some more extra growth. So now that we know our risk tolerance and the benefits of diversification, how do we find a high quality dividend stock to buy? In the UK, there's a load of different dividend paying companies, some great, some truly awful, and it's really difficult to find the difference without spending a lot of time. With that in mind, I try to filter it, and I look for companies with growing revenue and scaling earnings with it. This means as they grow their top line or their revenue, their earnings or profits continue rising with it, meaning that they have a consistent profit margin just with growth. Furthermore, I look for companies with great dividend histories which show that they've consistently been paying it, even in the toughest of times like the 2007 financial crisis, and also where they have been growing it at a faster than average pace to the markets, meaning they're growing their dividends just a little bit faster than average, meaning that your wealth or your dividend payments would grow faster than invested in an index fund, for example. I also look for companies that have payout ratios of less than 60%. This means that they're able to reinvest at least 40% back into the business to continue growing their revenue and earnings, whilst also paying out a healthy amount to shareholders in the return of dividends. Lastly, I look for companies with high quality balance sheets. This means they have little to no debt and high amounts of cash available, so that they're very unlikely to go bankrupt, mitigating that systematic risk in the portfolio. Also, on the off chance that they became unprofitable and had the cash on the sidelines, they could pay a dividend, although I personally wouldn't agree with this, as at that point I'd want them to use that money to become profitable again, but it at least means they could survive unprofitability for extended periods of time. I should also note that dividend yield is absolutely of no important factor to me, same with price to earnings ratios, but I'm not going to explain the latter just now. I think dividend yields are usually something newer investors fall into the trap of. They try and look for the best secure return on their monies, so they look for a high interest bank account. So you would look, oh, if I had an 8% bank account, that's great, right? I'd have that locked in, and yeah, it's not bad. You're not going to earn more than that or less than that, but at least you've got 8% income. Whereas with dividends, they're a lot more risky, and usually if a dividend is priced this high, it means they're of a lower quality, or that the share price of this company has been falling consistently. After all, if there was an 8% dividend yield available on a business, more people would surely be buying it, which in turn would push the share price up, dropping the dividend yield. But this isn't the case. I personally would see a red flag if a stock has more than a 6% dividend yield. At that point, I would look into the balance sheet and past financials very thoroughly to see why, and look in the recent news because there may be some scandal ongoing. It's all good now that we know what to look for, but how do we filter these and use it in action? I like to start with stocks with strong dividend histories and growth rates. And to do this, I will use a free website called dividenddata.com. I should disclaim, all of my sources used in every single video on the channel is in the bottom of the description down below. A lot of people ask me, oh, what's your portfolio using? Freetrade app, it's in the description. Or what websites did you use? Always in the bottom of the description down below. Dividend data shows us the consecutive dividend growth of companies in the FTSE 100 and FTSE 250, allowing us to see their dividend histories and also their compound annual growth rates, which I think are very important basis points. I would suggest FTSE 350 stocks, which is the 100 and the 250 like I mentioned, as they are more blue chip stocks in the UK. They're more well-known companies, less likely to be poorly managed and less likely to go bankrupt or go to zero, but not impossible. You could really look at it, but there would be a lot of red flags prior. Perhaps Thomas Cook, for example, is a recent one that had gone bankrupt. Then once I've looked at dividend data, I will then decide whether to research a stock further based on their dividend history and growth rate. And if you'd like a free share sign up to Trading 212 or Freetrade using my links in the description down below, when you deposit just £1 and you'll get that free share. So now that we're on dividend data, click the dividend histories tab at the top of the screen, then click the consecutive years of dividend growth and press that one twice. Now you will see a list of companies in the FTSE 100 that have grown their companies by around 20 or more years. This is a great basis point. This will show you the more defensive stocks that have consistently been paying. We might see an example of DCC, then we can see that their compound annual growth rate, and we can see that over the last 20 years, they've had cracking dividend growth. What we can see, however, is Halma, which is one of my personal holdings. This is actually how I found them originally. Even though it says at 21 years, they've had a dividend track record or history of more than 40 years. But this website only tracks back the last 20 years or since 2000, as that's when all of this information became online, and it's harder to track further back on a consistent scale for all of the companies on the FTSE 350. I could have bought shares of SMT or National Grid, which is Scottish Mortgage Trust, or NG. However, I didn't because their growth rates were quite low. Although in the case of Scottish Mortgage Trust, they've had cracking growth in the last year due to their high exposure to Tesla, but let's not talk about that in this video. National Grid, on the other hand, have grown their dividend above the rate of inflation, but it's not great. And that's because they're a utilities business, and so it's unlikely that they will be growing at a fast pace, but rather sitting relatively still in terms of revenue and earnings, and they're heavily regulated, so it's not one I personally would invest in. But if, for instance, you're in retirement already, and you're looking for a stock that can provide you with a yield of 5.56%, the National Grid isn't a bad option. But for those of you that are younger, have more time for dividend growth to kick in and allow to compound, National Grid really wouldn't be one I would personally invest in. Although I must note that I have held shares of National Grid in the past. Although, on the other hand, these could be used in as a hedge, as they will drop less in a market crash, at which point you could sell National Grid at a higher valuation compared to stocks that dropped 40% when National Grid has dropped 10%, sell National Grid and buy those other stocks that have dropped a lot more. But you could also do the same with bonds, but bonds at the moment have very low yields, aren't personally something I would choose. With Halma, we can see consistent revenue and earnings growth, a lower payout ratio of 36%, and a strong balance sheet with a debt to equity ratio of 33.5%. And these are the common trends I like to look for. Another example could be Decra Pharmaceuticals, which is listed in the FTSE 250. So on Dividend Data, you just got to click that FTSE 250 tab and do the exact same thing. We can see that they have 17 years of consecutive dividend growth and a 10-year CAGR, or compound annual growth rate, of 13.67%, which is very good compared to others in the market. DPH, however, has had a lot less earnings in the last few years, and it has certainly stifled off, leading to a payout ratio of above 100%, which is certainly on the riskier side, but at the same time they could recover this. But this could be a reason to avoid this particular stock, for example. I should also note that listing every company and the reasons to buy in this video would be so time consuming, so I've listed these two so you get an example of what to buy and perhaps what not to buy. Another method for scanning for the quality dividend growth stocks is by filtering on a 10-year compound annual growth rate on Dividend Data. This allows you to see the fastest dividend growth, or the companies that have grown their dividends at the fastest pace in the last 10 years in the FTSE 100 and the FTSE 250. Once more, if you look at either one of those, you can see some of my holdings. In the FTSE 100, you would have Ashtead Group, for example. They've only had 14 years of consecutive dividend growth, but their average 10-year CAGR is 30.81%, which is very good. Once more, they've had strong previous earnings, but very much impacted by the pandemic, maintain a dividend payout ratio of 29%, and a lower quality balance sheet with a lot more debt than equity and very limited cash, but this is due to their business model and how they lease equipment. So now I'm going to show you the portfolio that I have built on Trading 212, which you are more than welcome to copy, although I would advise that you do your own due diligence before doing so. This will also be in the link in the description down below. So I'll put it in the description. It will be monthly dividend income pay rise portfolio, and that will be it. This has a few extra stocks that don't fit the criteria. 3 of these. One of them would be GSK. They haven't grown their dividend in the last few years. Pretty stagnant earnings. In the last decade, of course, yeah, they have been trading sideways, but they have a higher yield, and I think it's nice to bolster up this portfolio with a little bit of higher yields, because a lot of the stocks here do have low yields, and if you're looking for an income, you would like that. Plus, they also have a quarterly dividend payment frequency, which is something that's quite rare in the UK, as many companies are biannually paying, meaning they pay twice a year, and usually it's in like January and September, so it leads to a massive overlap of companies all paying at the same dates, and you have gaps in your months. I've tried to guarantee that there's at least a dividend payment, at least 2 dividend payments each month, and therefore I've also gotten UK Greencoat UK Wind and also the Renewables Infrastructure Group, or TRIG. These both have 5% yields. They're infrastructure, green, clean energy trusts, and they would help bolster up the income in your portfolio, whilst remaining relatively safe, but they would only grow the dividend above the rate of inflation. The other stocks are Tate & Lyle, Safe Store Holdings, HomeServe, Cranswick, Softcat, Spirent Communications, Games Workshop, Diploma, Ashtead Group, Dechra Pharmaceuticals, and Halma. If completely equally weighted, even the Trading 212 pie is not equally weighted, you could have a portfolio yield of around 2.53%, which I think is a great balance between dividend income, higher than the rate of inflation, but also more growth potential in the portfolio, and that is something I would personally buy. I must disclaim that I only hold a few of these stocks. I hold Halma, Ashtead Group, and Games Workshop. In the past, I have held Softcat, for example, but I don't own the rest of these companies. Whilst also this portfolio remains well diversified between industries and sectors, and I will place it on the screen here. I think this is quite a good balance, although in the case of Tate & Lyle and Cranswick, you could certainly choose one or the other if you desired. If you'd have bought all of these stocks exactly 1 year ago at the time this video was made, you would have had a total return of 7.27%, consisting of 4.79% in capital gains, which is share price increase, and 2.47% in dividend income, which I think is really impressive when the FTSE 250 and FTSE 100 have returned, or in the last year have actually lost 10% in value. So not only has it beaten the UK markets, obviously in hindsight, but it's also gained consistent returns, which I would attribute to the average returns of the market. If you're interested in how many shares of a stock for £100 a month in dividend income, then click the card at the top right of the video. Thank you for watching. Have a great weekend.